Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I'm Austin Wilson, research analyst and co-portfolio manager at Hicks & Zerker Capital Management.
I'm Josh Robb, director of wealth management at Hicks & Zerker Capital Management. How can people help us with our podcast?
We would love it if you'd subscribe if you're not subscribed already, and check out our website. You can sign up for our weekly newsletter. It's exclusive just for our subscribers.
Yeah, exclusive to anybody that signs up for it.
So go ahead and go do that. But today.
Yes.
It's that time of year.
It is. I'm excited.
Every single year we do this. It's time for the, how many annual?
This is our fourth annual.
Fourth annual, The Invested Dads, second half, stock draft.
All right.
And by stock draft, it's not necessarily a stock draft as much as it is a stock
competition for a portfolio of selected investment choices.
Yeah, for the second half of the year.
Yes. 6 months.
So here is how this is going to go.
Yes.
Josh and I are going to be going over some of the rules, regulations, restrictions. We are also going to take a break for dad joke.
Yeah.
And then tell you some of our either high-level thoughts of what we're planning on doing, because we're recording this a couple weeks before, so things may change a little bit. I actually came prepared with a spreadsheet.
Yep.
So that's the way I am. But
I had a spreadsheet, and then I said, wait a minute.
But we are going to be telling you how you can go and join us and compete with us for 6 months of glory.
Yes.
And, you know, there might be a prize for the winner at the end of this, so you're going to want to actually try in this thing. So here's the deal. This is a competition with hypothetical money hosted on Investopedia's Stocks Simulator website.
Yep.
We've used this for a couple years now. We've kind of tweaked and fine-tuned the way we operate it, but the general thinking is the same. We have a private game. So a private game means that not everyone can join it. You have to have the password.
Yep.
You know what? We're going to give you that here in a little bit.
Yes. And we're also going to have it on our website and linked in the show notes.
And in social media.
It's
going to be everywhere.
It's not going to be a hard... I mean, the password's there just so that you have to have it to get in there, but anybody can join.
Absolutely. So here's the deal.
Yep.
100,000 hypothetical fake U.S. dollars, United States dollars.
Yes. Inflation adjusted.
Inflation adjusted for zero inflation.
For hypothetical inflation.
At the point in time when you get it. So you are going to get a blank portfolio with $100,000 of fake cash.
Yep.
And you're going to be able to deploy that cash as you see fit over the next 6 months. You're going to be competing not just with Josh and myself, but with other listeners as well.
Anybody that wants to.
Anybody who has the link and signs up and joins the game.
Yes.
We've tweaked a couple things this year to make it more fun, maybe? Question mark. So trading.
Yes.
Historically, we've often encouraged or had rules in place where it was a buy and hold strategy.
Yes.
This year, it is not. Trading is allowed.
Oh, boy.
100% allowed, and we have decided really that anything goes.
Anything goes.
You can buy things on margin.
Ooh.
Margin ain't free, but you can buy things on margin. You can sell things short.
Okay.
You can trade options. These are things that you couldn't do before.
Yeah.
And now you can. And we're not going to tell you how to do that. You can figure it out on there, though.
There's actually some stuff on there that shows you how to do it.
Yeah, absolutely.
Yes.
But those are additional things to the stocks and mutual funds and ETFs that you typically would have been able to get on there.
We had some people asking about it, so we thought we'd try it, see what happens.
Exactly. Here are some more details. You can actually join at any point leading up to this. Josh already did today after I
wanted to try it out.
It works. You can join anytime from now until December 31st, really.
Yes.
However, we'd encourage you to get started a little earlier. You won't be able to invest, however, until June 30th, which is the end of the quarter end of the month, beginning of the second half.
Yep.
Okay? So here's the timeline, 6:30 to 12:31. The second half of the year is when this will happen there. You are locked out to reset your portfolio. So if you really suck it up and sell short something that goes to the moon and you have no money, because that can happen. That's one of the things that can happen. Then you cannot reset your portfolio. There are 0 hypothetical trading costs, which is actually pretty realistic
Yeah, nowadays. Now, I will say, is that true for options and short selling? Because usually there's a cost associated with those.
I think there's none.
0 cross.
Yeah.
That's good. No
Across
problem.
the board. There are no maximum or minimum number or weighting of holdings.
We've
you
done
could
that
go
in
all
the past. We've capped them in the past.
We used to say like 10% in any one name or whatever. Nope. You can have all of it in one name or 1,000 names.
Doesn't matter.
If you want to manage that. Like I said, no maximum number of holdings. You will trade on the shortest amount possible, a 1-minute market delay in the software, which is pretty much real time. Margin. So if you borrow money to invest, it's called investing on margin, there is a cost associated with that, just like in real life, and that cost is 10%.
Okay. We hope it's 10%.
Yeah. I set it up to be 10%.
Yep.
Cash. If you hold cash the entire time, you will earn cash yield, and cash yield is set to 5% annually. So actually, if you hold it for the entire 6 months, you get 2.5%.
Okay.
Which, if the market falls apart, hey, you might look like a genius. Some people did that. It didn't work out last year.
Yes. Now, I will say, when I went in to log in, on my view, it said margins were 0.1% and 0.05% for cash. But then you showed me how you set it up. So I'm hoping it's right and just was a weird layout on how it showed it.
So those are the rules. But before we get into how we're thinking about doing this and how to join, you have a dad joke.
I do have a dad joke. So, made breakfast the other morning.
Ooh, good. On the Blackstone?
Made a mess. But I was going to ask my wife to clean up. But I was hesitant to. I was a little worried she'd be mad at me. So I've been walking on eggshells all morning.
Yeah. I love it.
I like that one. That's funny.
And eggs are delicious.
So let's recap the rules.
Yeah.
Trading is allowed. You can own pretty much anything out there that you can think of. You start with 100,000 fake dollars. You can do anything you want for the next 6 months, as much as you want, as little as you want, however you want.
Yep.
Pretty open.
It's pretty open.
Straightforward. No cost associated with this. You can join us. It's free. If you mess up, it doesn't cost you anything.
Nope.
If you win, you may get a prize. But other than that, just for fun.
Absolutely.
Okay.
So let's get into some of our thinking about how we're prepared for this. And I actually am prepared for this.
I'm prepared. I didn't write a sheet down, but I know what I'm doing.
So I have 11 ideas.
Okay.
And these ideas range in weighting from 5 to 20% of my anticipated, this could change, portfolio. And I'm going to tell you my rationale behind them.
Okay.
And you are going to go way higher level than that.
No, I have some individual things, but I didn't plan out all 100% of what I'm doing.
So my first pick.
Yes.
I want to invest 5%-ish position, TBD, into Chevron.
Okay.
Which is one of the largest diversified oil companies in the world, but in America specifically. It's diversified. It has not rallied with tech stocks this year, which is a common theme you're going to find with my picks.
Yes.
The markets are up largely because tech and big tech are up, and everything else is flat to down. And I want to buy things that have not gone up 100%. So that's one. It's trading at energy in general, is trading at a discount to the market. I like that, despite the fact that their profits as a proportion of total market profits are way higher than their market cap percentage. So I see opportunity there. You want to throw something in there now?
Oh, yeah. I got quite a few. So some of these individual holdings are because I like them or I think there's an opportunity. Some are more thematic ideas, and I'm not sure if I'm going to go with a ETF or an individual name. So that's where we're going. So the first one, which has actually done well as a stock, and by the way, we should caveat, all these are not recommendations because this is fake money.
Fake money.
We are making decisions because it is fake.
This
not
could
recommending.
be fake recommendations.
These are not recommendations for real life money. Okay.
And I guess let's also put the caveat in there that we are looking at a 6-month window of trading. This is not investing for the long term.
Nope.
This is not how Josh and I are investing our actual dollars for long-term success or would recommend anyone do that. We may do things and will do things that we would not recommend with real money.
Correct. So all those caveats to say when we're throwing out these things, these are what we're doing with our hypothetical fake money.
All right.
Not recommending. Okay. So we're heading into the summer.
We are.
And this
Crocs.
You got it. This stock has actually done well. If you look at the stock chart, it has actually done well.
I know.
So I'm going to own a little bit of Crocs.
Yeah.
I don't know how much. I don't want to go crazy because it has done well.
Yeah.
I think there's unlimited upside to Crocs just because the brand is just, put one on your foot and you're like, this is awesome.
I mean, I was hesitant, if you recall.
And you like them.
And now I have a pair.
Yes. So I am going to have Crocs in my portfolio, probably about a 5% weighting there. So that's my first
I
one.
like it. My second one is, and I've been at this multiple years, Bitcoin of some sort. It, depending on in the software what ETF or unit trust or whatever it allows me to hold. It could be GBTC, it could be something else. But Grayscale Bitcoin Trust is kind of the target. But something like that, I think that this is a way to get some exposure to the most widely known cryptocurrency. I believe that at some point we're going to have a little bit of a decoupling between asset classes, between crypto and equities, where they've been kind of positively correlated for a while. I think that they might be negatively correlated, which could diversify my portfolio. Okay. So only about 5%-ish in that as well.
And now that was another one of mine, is the same thing. I think it's been under a lot of pressure. It's trading at what, 25,000? The high was 69,000, 68,000. Yeah, somewhere right in there, upper 60s. So I think there's room that will eventually get back to there, question mark.
Yeah,
but
no guarantee.
I think there's a little more upside. And I think with the SEC's approach to wanting to do some regulation, and they've been taking more of a notice that actually in the long term will be an upside. Whether it's 6 months upside, I don't know. But I also plan on having a little exposure. The other approach may be through like a Coinbase, which is a stock publicly traded. It's down like 90% since its initial public offering. It may, because they're also regulated by the SEC and is actually right now having some scrutiny by them.
Yes.
I'm not sure, but I'm going to take an approach one or another to get some digital currency exposure. Those would be one of my two choices. So same boat as you. Not much, but a little exposure there.
In the same thinking of diversification, which we would say is a great thing in a lot of ways, I will be taking roughly the same exposure, roughly 5%, and putting it into the ETF or unit trust or whatever it's classified as for gold.
Get some gold.
GLD. It is kind of running into some resistance around all-time highs, but a good diversifier if the economy slows down. A good diversifier when you look at the real yield tracking and how it interacts with that over time. I think there could be some upside there, but I think, again, a small portion of my portfolio to diversify away from the equity market.
Mm-hmm. So this is one that has an asterisk to it on what I wanted, which I started thinking about this a couple weeks ago when you were out, and I was getting some of my notes together and everything, and it's changed a little bit. So I'm going to just say this is what my plan was, and it may or may not happen by the time I actually go to push buttons. I was going to get some long bonds. My thought was an ETF or something for the longer end of the bond world. Originally, I thought, hey, I think the Fed may cut rates at some time this year, and so lowering rates increases bond prices. The longer end will be exposed to that, and they got beat up pretty hard last year, so there may be some upside there. The Fed had their meeting in June, decided to pause, but their language indicate they may not be cutting rates this year, but maybe next year. That still may move the market based on futures, but I'm not sure how or if I will expose to the long end of the bond market, but that was a plan of mine. That was on my list.
Well, Josh.
Yes, Austin.
We've not talked about these in advance. So I'm just going to skip a couple numbers down. One of my sizable positions is ticker TMF. Ticker TMF is the Direction 20-plus year Treasury Bull triple leveraged ETF.
Oh, there you go.
So this means that long bonds, more interest rate sensitive, rates shot up, they got hammered, they're down 20, 30%. If interest rates on the long end, it's really where interest rates on where the bonds are, so longer rates go down, prices will go up. Mm-hmm. I think there's more downside to rates on the longer end. The Fed doesn't move. The Fed is moving things on the short end a lot, and it's moving a little bit on the long end. But I think that there's a lot of room for upside in terms of price appreciation, and I'm going to capture 3 times that.
There you go.
So I am anticipating, this could change, but right now I'm actually planning on about 15% of my portfolio in the triple bull long bond ETF.
Okay. There you go. So my thought process wasn't too flawed, and where I was leaning on the longer end.
Maybe mine's wrong.
I wasn't as aggressive as you on that one. Now, here's the other one where, again, earlier I was all in on it, and I'm still there, but not all the way. Was looking into travel and leisure.
Okay.
Because we've seen a big upswing over last year and into this year of people taking vacations, traveling, all that. In fact, I saw some articles on the news. They were talking about cruise lines being overbooked and needing to rebook or move people around because of the amount of demand they were getting. So I was going to lean into that space, whether it was one of those fun named ETFs I could find or a couple stocks individually, whether it's an airline or a cruise line. And I still think I'm going to go in there, but I'm not sure exactly how far I want to go on that side. But I think that trend will continue.
Yep.
I think there's still demand, and it will continue through.
All right, my next pick. Now I'm all out of order because I
excited you.
Ticker LTHM. Sounds like lithium.
Oh, I don't know.
That's because it is. It's a company called Livent Corporation.
I thought it was long-term hot metal, and it was some sort of like welding thing.
Yeah. About a 5% position planned for Livent Corporation. Lithium very in demand when you look at electric vehicles, which are growing very consistently, not just in the United States, but around the world. So
you sound like you're farming
position,
them. They're growing very well.
Growing very well.
It's a good crop this year for electric vehicles.
Getting some materials, some lithium exposure.
Okay, there you go. All right. So then, as I was looking at my portfolio, I think my next piece is, and maybe this sits to what you were talking about earlier, is when I was looking at opportunities. Tech has had a pretty good run at the start of this year. I was looking at more high dividend or high quality, and I know there's different ones out there. There's like a Morningstar dividend thing. I was going to look in that basket for a high yielding dividend or a more value oriented diversified ETF. So I'm going to have exposure there to get stock market exposure, but in a more value or quality side of the large cap market.
Absolutely.
So again, not sure which one I'm using, but that's the sector I'm leaning into.
Yep. My next individual name is Charles Schwab. Charles Schwab is one of the larger custodians. They have a banking arm. They're in wealth management, all this other stuff. Because of some of the banking turmoil and really yield moves and stuff like that, have been absolutely hammered this year. They're down 30%, I think, something like that. But it's a fantastically profitable and quality business model that I think will bounce back and is being underappreciated. The uncertainty is being overstated, I think, for them. So 5% position in Charles Schwab.
There you go. I'm going to then sprinkle in
just a little bit,
a couple fun names because I love those. I didn't do well last year.
Is there a ticker JOSH?
No, they're owned by somebody else. I was going to say the Joseph A. Bank clothing company, but no. I said I didn't do well. I finished middle of the pack last year in the stock draft, and I chose all fun ETF tickers or stock tickers. There's a couple I really liked in there, and I kind of liked what they did, so I'm going to pull those back in. FUN was one of them.
It was. That's Cedar Point. Cedar Fair.
Yep. So that may be one. It's just close to us. Don't have any thoughts to it. Never looked into it at all, but it's a fun name.
It's America's rock and roller coaster.
But I will sprinkle in a couple of those from last year that I like, and they'll show up as just fun tickers in my
small
portfolio.
Positions.
Yeah, nothing big, but those are a couple that I'm leaning towards as well.
I like it. My next is ticker SLB, Schlumberger. It's a really technology-oriented, technology-focused energy company. So they provide a lot of the infrastructure from a technology basis that other energy companies use. I really like that. They've also not rallied as much as tech in general. They're an energy company, technically. So I like the exposure there. I think it's tech energy, and I think energy could still do well. The economy is still growing. It is slowing, but it's still growing, and I think that's good for oil demand, which should be good for the energy sector in general.
Yep. The other one, it's two names. I'm going to use them together. Disney and then Universal, which is owned by Comcast, I believe. And so those are the two I'm going to put in. Disney is just releasing the newest Indiana Jones movie.
Oh, yeah.
Which I'm pretty excited about. And in general, with travel and vacations and all that, I think there's a good trend there. And HBO Max, I think they changed the name to Max.
Yep.
They're releasing a Harry Potter new
show.
It's like a 10-year a redo. So I think there'll be some excitement around that. So, and they're opening a new park, which is a Mario themed one as well. And so I think there's some some stuff there, and I got kids.
Kind of also goes with your travel thing.
It goes with my travel. I got some kids that are all in on some of those. The new Mario movie that just recently came out was a big success.
I heard it's good.
Those are two names that will show up in my portfolio. Probably, again, 2 to 5%, nothing huge, but a small weight in each of those.
My next is ticker GEM, which is a Goldman Sachs ETF tracking emerging markets. And it's what they call an active beta ETF, meaning it's a quantitatively run strategy that uses rules to determine, based on a couple different factors, not going to get into details, companies that they think should do better than other companies in the emerging market space specifically here. And they put slightly higher weights on the better quality companies that meet those criteria and lower on the others. It gives you emerging market exposure. I'm optimistic still. China is reopening for one, but they're stimulating their economy again from the top down.
I saw that
they do.
in an article I was reading.
And I think that has to be good for growth. They're going to grow at more than 5% this year, which is really good for a worldwide comparison. So,
all right.
There we go.
Sounds good. Those were my broad ones. And I think I'm going to then, because like I said, those the bigger bulks, I'm going to have bigger holdings in some of those, like the dividend paying ones. So that covers a wider swath of companies.
Yep.
And then I do want some international exposure, maybe a more of a global fund or something like that to get that. But that was kind of where I was sitting on my choices.
Yep.
Ones I'm planning on not being in, at least at this point, are really any direct real estate stuff besides my more broad ETFs. And healthcare is one I'm not sure of yet. I was leaning towards doing something in healthcare, and I just haven't found anything exciting for me that is like fun to do.
So I am taking the over on healthcare.
Okay.
So I'm taking a sizable, about roughly anticipating a 10% position in United Healthcare.
Okay. Yep.
So United Healthcare is the nation's largest healthcare provider. They've also been really beat up recently. From firsthand experience using their products, I can understand how profitable their business is because the healthcare world is ridiculously expensive. So, taking about a 10% position in healthcare. And you said you're done, so I got a couple more.
Yes, tell me a couple more.
Here's another one, taking about a 15% position in more fixed income. Austin and fixed income?
You're in it.
Ticker BOND.
Bond.
Is PIMCO's actively managed. PIMCO's one of the world's leading fixed income managers.
Yes.
They have an actively managed, so they're picking and choosing what bonds and fixed income they want to hold there and managing yield and credit. But it's their actively managed bond ETF.
Okay.
So ticker BOND. So between the two, the long bond and BOND, I'm at about 30% fixed income.
Okay.
10% I would call real assets with Bitcoin and gold, which would make 60% I would have in equities. And you're like, 60%? I'm missing about 20. Austin's largest holding.
What's it going to be?
One company, but it's a diversified company.
Okay.
In Buffett we trust.
Okay.
Berkshire Hathaway.
20%
20% of the portfolio. This is my only indirect exposure / kind of direct to having a bunch of tech. So about half of his company is essentially Apple.
Yep.
He's one of the largest shareholders. So I'm getting technology exposure through Berkshire. But I'm not, if you've noticed, making big bets on AI right now.
You have not. I think it's overplayed a little bit.
I am looking at the market and saying, I think that AI is going to do great things for businesses and people. I think that tech companies are going to continue to do well, but I think a lot of their stocks on both the big tech and the alternative or the artificial intelligence focused areas of tech have run up too far. I think there's risk there. So I'm not taking big direct exposure to them. So
Makes sense.
That is my winning portfolio. Probably not.
Yeah, there you go.
So that's what I'm saying. And again, all trading is allowed. Some of these things may change by the time I actually get these trades in there, and you too.
Yep, and I have to remember what I said today when I go to invest it so that I get it all in there.
Absolutely,
correctly.
at least for a minute.
Yeah.
Until you trade it that way.
That's right.
All right.
Question, one more for you.
Oh, yeah.
Question. Do you plan on going all in on all your trades right away? Are you dripping in? What are your thoughts on that?
It depends on what the market's doing at that point.
Okay.
So on July 1st or June 30th or whatever that looks like, if the things that I want to buy are at a point where I want to buy them, I'm not opposed to putting it to work right away. I only have 6 months to make money.
Yep.
That being said, if things are way overbought, which there's ways to technically look at that, I will probably wait for a pullback.
Okay.
We'll see.
All right. Sounds good. I am, based on the things I'm thinking about, the more diversified pieces, I'm pretty comfortable getting in right away. So some of those more broad ETFs that I'm going to be using, I'll probably put those to work. Some of the more individual names, I'll do the same thing, is just kind of look at where they're at and see if there's maybe a better opportunity down the road.
Absolutely.
So, yeah, at least a good chunk of my portfolio will probably be invested pretty early on.
I do want to caution our listeners. So one of the things I mentioned is a triple leverage ETF. These are very popular now.
Mm-hmm.
You can do them even for companies, individual company, triple leverage ETFs. Triple leverage can burn you. And I just want to put that out there as a warning.
Yes.
They're made to trade, not to hold, because when upside and downside converge, you have issues. So on the upside day, you're going to get triple up.
Yep.
But triple up off of a lower base, because that's how the math works.
Yep.
Triple down hurts you worse than triple up. So if you're holding a $10 triple leverage ETF and it goes up 50%, great, you go to $15. But if you go down 50%, you go down to 5. So it's comparatively harder.
Yes.
It's really tough.
Yeah.
So that's why be careful with triple leverage.
Good thing it's fake money.
Good thing it's fake money.
Yep.
All right. So how do you join?
Yep.
First of all, this is going to be plastered everywhere.
Everywhere.
Website, social media, the Facebook posts,
Facebook.
Show notes, email. So there's going to be a link in the email. So that's another reason to sign up for our newsletter. That makes it super easy. Yep. You have to search it is TID second half stock draft 23.
The number 2 ND.
Yep.
Okay.
And that is what you'll search for. So the password.
Yes.
The password, because it's password protected.
Password protected.
Capital T, lowercase I, capital D, lowercase o, lowercase n, lowercase u, lowercase t, 2, 3.
Okay. So it's TID.
Yep.
And then the D goes into the word donut.
Yeah.
And then the 23.
Yep.
Okay. TID. And then that's donut.
Yeah.
23.
TI donut 23.
Yeah. All right. That sounds good.
That's the password. So ideally, as we mentioned earlier, get your picks in early, take your time. But you can also take your time to drip in if you want, but it's more fun that way. You can't do your picks early, but you can get set up early. We would encourage that.
Yep.
Email us at hello@theinvesteddads once you've submitted your portfolio or once you've bought. We'd like to hear from you and know what you're thinking, how you're feeling, or if you have any questions about any of this.
Or just want to throw down the gauntlet.
Or just say, hey, bring it. This is the winning portfolio, and I'll challenge you is what you'll say.
Yeah.
So that'll be that. But otherwise, this is going to be really fun. We're going to be tracking it throughout the second half of the year. And it makes it a lot easier that it's online now than we used to do one in Excel. That was tricky.
Yes.
So thank you for listening. And we're excited to do this with you again this year.
One last caveat. Just a reminder, all those things we talked about that we're investing in our fake portfolio is not a recommendation for real life money. It's just something we're doing for fun. So no recommendations on any of those things.
And if you had someone asking, hey, I'd like to do a fake stock draft, send them this episode. Send them a link.
Sign up.
Get them to sign up with that. And if you have any other ideas for other podcast ideas, send them our way. We'd love to do that. So email us at hello@theinvesteddads.com and we will take a look. And until next Thursday,
talk to you later.
Have a great week. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.